We use our macro weather model to assess the probability of regime change in asset markets over the short to medium term time horizon. So let's unpack the principal components of macro. Let's start with the real economy cycles on the left. Monthly real GDP growth is accelerating at 2.1% on a trend basis. Is expected to inflect by Bloomberg consensus and trend lower by 80 basis points over the next 12 months. Headline CPI is currently trending lower at 3.3%. Is expected to inflect and trend higher by 72 basis points over the next 12 months. The unemployment rate is at 4.2% and trending higher. Is expected to trend higher by another 30 basis points over the next 12 months. The implied sales growth rate for the S&P 500 is trending higher, 4.1%. The implied earnings growth rate for the S&P 500 is trending lower at 5.6%. The sovereign fiscal balance to nominal GDP ratio is trending lower at 6.8%. So the budget deficit is widening as a share of GDP on a trend basis. As predicted, the U.S. dollar real effective exchange rate, that number inflected into a downtrend as well. The financial economy cycles, so liquidity, U.S. liquidity and global liquidity are currently trending higher. Domestic credit growth and global credit growth are trending higher, 4.1 and 4.7% respectively. The benchmark policy rate is trending lower. It's expected. It's the 2-year nominal yield spread relative to the benchmark policy rate is trending higher. So the market's pricing out rate cuts at 51 basis points in terms of that spread. And then aggregated positioning in dollar and treasuries is in extreme bearish conditions. And aggregated positioning in the commodities and equities markets are extreme or neutral positions. So each of these component features contributes independently to each of these composite signals here. And so the constellation of composite signals currently indicates a high probability of sustaining a risk-on market regime over the next 3 months. Again, I would say, this is what the macro weather model is just saying, based on everything we can observe in the data, it's a decent time to be taking risk as an investor. Now, the macro weather model can observe President Trump tweeting about Europe. It can't observe congressional brinksmanship with this, what's likely to be a push-pull between the Senate and the House. We think the bill gets bigger in the Senate, if only because, for one, it's harder for them to resist the demands for populism in the Senate because, again, you have 2 senators per state. It's not like, oh, I'm in this one town, I'm in this one district where everybody in the district is a card-carrying libertarian and doesn't like budget deficits. It's no, I represent the entire state of Texas or the entire state of Florida. And so it's going to be a lot harder, more challenging to, implement these work requirements from Medicaid and things of that nature. So the bill's probably going to get a little bigger in the Senate. And ultimately, we think the bill gets passed into law, but you're going to have the Chip Roys of the worlds and the Jason Smiths of the worlds push back on that and create some brinksmanship. But ultimately, we do think the bill gets signed. And ultimately, we think the trade negotiations will largely wind up with producing positive outcomes. Now, again, the path to getting to those positive outcomes may require some negative truth social tweets or whatever you call them. I don't call them truths because I think it's an absurd thing to name a social media platform Truth Social and then call every post you make a truth. That is brainwashing if I've ever seen it. I mean, you got to be some kind of fool if you out here are going to say, oh, he truthed this. Just because someone says something doesn't mean it's true. Now, it very well could be true. It could also not be true. So I'm not going to call them true. I'm just going to call them posts, truth posts. No, that's neither here nor there. Sorry. As you can tell, I'm having some fun this morning. But anyway, so my key takeaway is that there's the path to getting to, the next 20% up move in the stock market, the next 50% up move in Bitcoin. The path to getting there is not going to be linear. There's going to be volatility, headline-driven volatility to risk manage this summer. Obviously, we got the July 4th deadline for the 90-day extension. I don't know if that's going to be a good or bad catalyst. Could be a bad catalyst if if Trump tries to take too much in these negotiations. Could be a positive catalyst if they dump a bunch of positive trade deals on our lap on July 4th. And then we have the Section 232 tariffs. I don't know when those. I don't know if we know. Cause I don't think it's been communicated when those investigations will be done. But we know those are negative coming ahead of us. But again, a lot of this is becoming known knowns for the market. What's the unknown? The unknown is how President Trump responds to a lack of progress on the negotiation front. How he responds to potentially feeling disrespected, and ultimately the congressional brinksmanship. Those are all things that could cause the market to pull back and correct. But again, I think the next 10% move could potentially be lower. The next 20% move is very high probability that it's higher. So just be aware of that. We use our grid model to assess the probability of regime change in asset markets over medium to long term time horizon. I think I brought this up last week, but we have growth slowing. We were early in having growth slowing going back to the summer of last year. Consensus finally caught down to our growth expectations, and they're actually below our growth expectations now when you get into the second half of the year. So this is something that will create upside risk in financial markets if growth is persistently surprising to the upside, and or consensus is making positive revisions to their GDP and earnings growth forecast in the second half of the year. So be aware of that. And then consensus, we started the year forecasting, going back to last summer, we started to forecast an inflection and trend higher in inflation here in 2025. And consensus, much like the Fed, had a durable deceleration in inflation. They've since revised, both those institutions, Wall Street consensus and the Fed, have revised their inflation targets higher to match that of our own. So we don't really see scope for inflation to surprise to the upside anymore. So again, you're removing left tail risk from the market by having consensus potentially come in, consensus growth expectations are now lower than ours. And so if we're right, and that's right tail risk for the market. And now we could potentially have inflation surprise to the downside as well. So we'll see. Just be aware of that. We use our global liquidity monitor to now cast the leading indicators of private and public sector liquidity across geographies. So as I mentioned last week, every country in our global liquidity monitor has liquidity trending higher, and that's obviously contributing to global liquidity, the uptrend in global liquidity as well. So as we talked about last week, this is potentially ameliorating. And potentially truncating the global debt refinancing air pocket. So we're not as concerned about that catalyst as we were heading into the year when we said the market would crash. The market did crash, so move on. Let's go.